Hello, everybody. Hello, Eric. There
Morning,
you are.
Ed.
How are you?
Good.
Good, good. Well, thanks lots for joining us. It's September 9th. How quickly time flies before we know it. It'll be October and then November, and we'll have a new president and a new Congress, and then we'll see whether everything calms down or goes the other way. So lots of suspense here on the political front. Meanwhile, on the economic front, there's also a lot of suspense. Before we get to that, Eric, how's it in Santa Monica? How's the weather these days?
It's been pretty bad. Big heat wave for the past like 5 days, but should be ending like today or tomorrow.
Yeah, you should have stayed on the East Coast. We've got beautiful fall weather, so I'm always pleased when the weather's better here than it is there, though not for you, obviously, but just to let you know that I like the four seasons. We have that here.
Yeah.
Unfortunately, I have to pay high taxes to enjoy the four seasons, but that's my personal problem. Eric, today there's lots to talk about. The morning briefing we wrote is about our view that we're in another growth scare. I kind of doubt that you woke up that early in the morning in California to see me on Bloomberg surveillance at 7 a.m., but I was on this morning. And the question they asked me, one of the questions they asked me was an interesting one, and that is they reminded me that it wasn't too long ago that I said if the Fed lowers interest rates more than the economy needs and too rapidly and kind of gets panicky about the need to lower interest rates to avoid a recession, that that might very well get a melt up in the stock market. And I think that was a pretty accurate description of what was going on until we got to a record high on July 16th, but that hasn't been the case since then. I think back then the S&P 500 was 5,666 thereabout. And now we're under that, not a great deal below that, but clearly some areas like technology has gotten hit quite hard. But so they asked me, well, now what we are saying is that if the Fed cuts interest rates too much on September and goes for 50 instead of 25, that might actually cause stocks to go down. And so she asked me basically, what happened? And I told her, well, time flies when you're having fun, and things have happened since our call, that if the Fed lowers interest rates too much, the market will melt up. And I guess what I certainly didn't see coming was the unwinding of the carry trade. And we got a glimpse of that on August 1st, and the early part of August, I should say. And now I think last week, a lot of people were scratching their heads. We were wondering how could you have the stock market go down so sharply, particularly on Friday, when the weak employment numbers didn't necessarily scream that we're going to have an imminent recession. And besides, the Fed is committed to averting a recession. So if a weak number means lower interest rates, shouldn't that be bullish for the stock market? And we concluded that here we go again. We had another continuation, if you will, of the unwind of the carry trade. So we still think that was a big part of it. And Eric, why don't you just remind us of how the carry trades was supposed to work and why it's getting unwound?
Yeah. Like any kind of currency carry trade, you borrow at low rates or in a country with very low interest rates, and then you reinvest it in a country with higher interest rates, or into other assets. Japan is like a generationally cheap funding source. After Europe exiting negative rates, it was really just Japan. Kind of makes sense. You're going to get some volatility or selling when, UEDA and the BOJ seem pretty committed to finally raising rates and getting out of that NERP reserve regime.
Do you see Eric? You can see the screen I put
Yeah.
out. Yeah, yeah. I think that's a pretty it's a pretty simple and yet powerful chart showing that kind of showing the fingerprints of the carry trade when the yen was weakening because the Bank of Japan was keeping interest rates near zero. It made a lot of sense for traders to borrow in yen at zero and then convert those yen into dollars and buy the Magnificent Seven, the NASDAQ 100. And so you've had this very strong inverse relationship. So yeah, if the Fed goes for 50 basis points on September 18th, that could once again give us another unwind of the carry trade. But we're not in that camp. We're not in the 50 basis point camp. We're in the 25 basis point camp. And we think that the market can handle that relatively well. We're also still not in the hard landing camp. We still don't see a recession. Some pretty smart people are out there still talking about that being almost inevitable. Fewer than there were at the beginning of this year, and certainly than there were in 2022 and 23. But still, our friends at Bank Credit Analysts, for example, to name names, are quite convinced that we're going to see a recession pretty shortly. Anna Wang at Bloomberg is in that camp. So again, some pretty smart people are seeing signs of a recession. Let's look at kind of update our charts here on where we are on that whole issue. So let me go here, share the screen, and then let me make that go away, and we're here. So as you can see, Eric, why don't you just kind of go over where the market is and kind of where we are on Fed funds rate cuts.
Yeah, I mean, you can see from this chart, it's gotten so extreme. The futures pricing for how many cuts the market expects, or at least is hedging against, between 9 and 10 over the next year, or 6. So 6 would be 150 basis points over the coming 6 months. That's pretty extreme. That's like recession level pricing. And it's just the market expecting some sort of normalization to take the real Fed funds rate lower. It's definitely not where we're at. I think we're more, we'll get one in September, depending on where the summary of economic projections comes in. We might see another or two that throughout the rest of this year, but definitely next year, the pace of easing should not be this strong, as long as growth, which we expect, comes in strong. You just don't cut this much when real GDP is growing between 2 to 3%.
Yeah, this is just another slice and dice, the same thing we're showing here. This just kind of shows the curve of expected rate cuts, and this is what the markets was looking at pre-Jackson Hole, before Powell's extremely dovish speech, and what the expectations are now. And we think that's just too dovish. We don't think the economy needs as much help. And by the way, it's not exactly like we're talking about a disaster scenario. If the Fed cuts more than we're expecting, well, we'd just be wrong about where you want to take your profits, or where you want to be careful about not buying too many more bonds. But it wouldn't be a disaster. Quite the opposite. If they overdo it, then we'll be back to talking about a melt up by year end. And we're still using 5,800 for the market by year end, and we're still talking about a choppy market. We've been talking about that really since July, and that's basically what it's been. It hasn't been a bear market, hasn't really been a correction. Some of the sectors have had corrections, like technology, maybe the NASDAQ, but we're not talking about 20%. We're talking more like a 10% kind of decline. So this is just the FOMC Fed funds rate median projections. Eric mentioned this summary of economic projections that the FOMC puts out on a quarterly basis. The next one will be out in September. And here in the June meeting, which was the second quarter forecast, they were saying the Fed funds rate was going to be at 5.1% by the end of the year. I mean, they were into the one and done projection, and now people are talking about 3 rate cuts. We're conceding the point that we'll probably get 25 basis points in September and maybe another one in November or December. But again, we actually looked at the employment numbers and saw some strength, which may counter that. We'll look at that in a minute. Eric, a lot of people like, I guess, your old boss at the Federal Reserve Bank of New York, John Williams, have this thing about the real federal funds rate. and what is the neutral rate. This is again the FOMC longer run median projections. And in June, they were saying that they think that over the long run, which I think is just another way of saying the nominal neutral Fed funds rate is 2.8%. How do they get that? Well, they do have a fancy econometric model, but I think to a lot of extent they go like this and see which way the wind's blowing, and kind of it's a total and complete guess. Our total and complete guess is that number is too low and should be raised because we think the economy is more resilient. We think there's more productivity. And if that's the case, then maybe the number is more like 3.5%. But this is where they were at that point. We wouldn't be surprised if they raise it to 3%. I don't think they're going to like embrace the market's expectations for where the Fed funds rate's going in the summary of economic projections. That would be, I think they can talk dovish, but I don't think they want to be quite that dovish in print. But they will be obviously talking about lower Fed funds rate. I mean, this was what they were saying in June for the federal funds rate for forecast for this year was 5.1, and for next year 4.1, and the year after that 3.1. And I think the market thinks this is all going to happen next year. Let's move on here. Eric, you want to take us through a little bit on what our spin is on the disinversion of the yield curve, where it might be going? And by the way, we're going to have to remove some of that blue line, remind me, because presumably the monetary tightening cycle will be over in September. So a lot of people kind of look at this chart, which is the same chart, but it shows recession shades, and you can see that the yield curve is supposed to, when it inverts, is supposed to predict a recession, and then when it starts to disinvert, it actually predicts that it's coming like around the corner. We had that a few times back here. You want to just give us an update on our thinking for this disinversion and steepening?
Yeah. So as I'm sure most people noticed from the flurry of iPhone notifications, the yield curve disinverted. Typically that precedes a recession because the yield curve did invert as bond investors thought there'd be some sort of financial crisis because the Fed funds rate was higher, it would break something that would cause a recession and a rush into duration. And then as the Fed cut, it would rapidly disinvert. We're obviously not getting those rapid cuts right now. We're kind of getting a policy normalization, or that's what the Fed is guiding towards. But I think this chart's interesting because the yield curve is supposed to be upward sloping, right? So if you take the average of past like peak upward sloping or peak positive slope, you get about 200 to 220 basis points. So if we have a Fed funds rate, like a terminal rate around 3%, we should be at 5.2% on the 10-year just based on that. We're obviously not anywhere near there. We've been making new lows on the 10-year, both in terms of nominal and real rates. We're at like 3.75%. So something's wrong there. You know what I mean? Even if we get to 3% on the Fed funds rate next year or in pretty short order, which, the 10-year shouldn't really be trading at 3 3/4. So I think we still think. Go ahead,
Eric, let me just jump in here and point out that you're saying if the Fed funds rate goes to 3%, we should be more like 5%. The other way to engineer that or unpack that is to say, well, the bond yield at 3.75%, let's say, is projecting that at this steepest point of the yield curve, the federal funds rate will be a lot lower.
Yeah.
I mean, if we're talking about 200 basis points, we're talking about a Fed funds rate of 1.75%, and that just seems like totally far-fetched. But so there's something off here in the way the markets are pricing where we're headed, and if we're right, then 375 may actually be a bottom, and 4.25% may be kind of where the bond yield should be. And maybe at 200, that would imply a 2% Fed funds rate. But I guess our thinking is more like 3%. Maybe, we don't, these things don't have to be precisely equal to the average. It could be below that for a while. Let's get into the employment report. Again, deja vu all over again. A month ago, we had a weak employment report, and the stock market took a dive, and we think that was the carry trade playing out. The Fed's going to have to lower interest rates. The Bank of Japan's raising interest rates. Let's unwind our carry trades. And the same thing we think happened on Friday. The employment report was weak. All of a sudden, people talking about not 25, but 50. So the carry traders freaked out, and they sold what they had to, and a lot of those were highly volatile stocks, technology stocks, and particularly semiconductors, and they got whacked pretty hard. When we look at the employment numbers, they weren't all that bad. Look, they weren't great. 142,000 isn't wonderful, but it's not minus 142,000. Total private was 118,000. I mean, everything was basically up except for a couple down here. Manufacturing was down 24,000, and that's a pretty volatile series. It could be flat to up in the following month. Retail trade, that could be some productivity going on here. Retailers are using more alternative ways of getting people into the stores without having as many employees on staff. And information technology, well, those people always find jobs, so it's something to be particularly concerned about. Meanwhile, when you look at average hourly earnings, it turns out that some of the areas where we had the weakest employment had some pretty significant, they had better than average wage increase. So for example, information technology was a downer on employment, and yet it was up 0.9% here on a month-over-month basis for average hourly earnings. Look at retail. Retail was down, as we just saw, and yet average hourly earnings were up 0.7. So this is not kind of consistent with the labor market that's falling apart. And then Eric, want to tell us why we look at this particular series?
Yeah. So like you kind of want to know how many overall hours are being worked, so you can think about productivity and incomes. So private payrolls edged up, 0.1% in August, but the work week increased nearly 0.3%. So like the aggregate hours we're getting worked in the economy were up 0.4% month over month. That's obviously a positive for personal income, and we're expecting that to flow through to retail sales this month as well. So it's not, that weak of a report. It actually has some strength underlying the hood.
And this has implications for our earned income proxy. But I think we're going to go there in a minute. But before we go there, here's again the aggregate weekly hours that we just saw here. This is the year-over-year percent change. And the year-over-year percent change is 1.1%. That's, the arithmetic of real GDP is simple. It's aggregate weekly hours growth plus productivity growth. And so we've had average weekly hours grown around 1.5%, and yet real GDP has been doing 2.5 to 3% in the past few quarters, and that's because our thesis that we're in a productivity growth boom isn't really a forecast. It's actually been happening since last year. We've had some very solid productivity numbers. Then while everybody's bummed out by the weak payroll number, we would point out that we could have a really, really strong earned income, wages and salaries and personal income. You can see that if you take a magnifying glass here, you can see that our earned income proxy for that variable rose to a new record high. And I think it was up 0.7% month over month. And we don't know. We're postulating, and everybody seems to agree that the CPI is going to be up 0.2%. So that's a pretty solid increase in real purchasing power, and that should be seen in retail sales. Just to make sure that we're not being totally biased to the positive side, we recognize the diffusion index shows that fewer industries are reporting increasing payrolls, but it's not zero. it's 53% on a 1 month basis. And so there's still companies increasing payrolls. It's just not as red hot as it was back here. And it's when, when it turns decisively negative, that's when you get a recession. But we don't think that's what's going to happen here at all. We had similar kind of tests of this line and of the 50 line without any problem whatsoever. The weak area of the report was the production aggregate hours, and that was basically flat. I think it was up a little bit. But this aggregate hours is a good indicator of what production is going to do, and so it looks like we're going to have a terrible month of production, or not a good month of production in August. Then again, this is what happened in July to motor vehicle production. In July, it took a big drop. I think we can pretty well anticipate that it's going to bounce right back up. So that might help offset some of the weakness in the aggregate hours. And again, that could be a productivity story. Eric, you're doing a lot of work for tomorrow on the unemployment situation. We've discussed this before. We've keep developing some charts that make it a little bit easier to see the story. You want to tell us the story we're seeing here?
Yeah, I think in summation, we're seeing a layoff environment that's really benign. Layoffs they're pretty muted. We're not seeing a lot of growth. Where we are seeing higher unemployment is from new and re-entrants to the labor force. And then the hiring environment is cooling. So that's that green line. If you were unemployed, you stayed unemployed. So it's tougher to find a job, but there's not really like a big wave of layoffs coming, and that's what you see in recessions.
The layoffs are this blue line, right?
Yeah.
That'll be people going from employed to unemployed.
Yeah, if you slice and dice the reasons for why someone's unemployed, those who are temporarily and permanently laid off are still below just people entering the labor force and starting to look for a job. So, that's a more labor supply dynamic rather than a decreased demand dynamic.
And we're also looking at some more of the data on unemployment by age group and by education, and it looks as though everybody points out that the unemployment rate is still low at 4.2%, but it's up from 3.8% a year ago. And what we're looking at is data showing BLS data showing that a lot of the high schoolers and people with less than a high school degree, a lot of those people were really in high demand coming out of the lockdowns. There's a tremendous demand for labor, especially unskilled labor, and they had a really good time, and their wages really went up a lot. And now we're sort of normalizing. We're coming kind of back to where we had been before the pandemic. It's not a terrible job market for high schoolers and for teens, but it's kind of back to normal, and that may account for some of it. And Eric, you pointed out some of that may actually be the illegal migrants, to the extent that they're getting hired off the books in cash at a lower price, whereas teenagers would probably be more likely to be on the books. That may be an issue for why teens and people with less than a high school degree are finding that the labor market isn't as red hot as it was before. Does that kind of agree with what you're looking at?
Yeah, I mean, if you look where unemployment has risen the most, it's in like border states and blue states with a lot of immigration. And then if you think about like where does unskilled, undocumented labor go to, it competes with jobs for native born people who are quote unquote unskilled or have less educations, or like teens doing summer jobs, stuff like that. So it's consistent with higher immigration, but unfortunately it leads to fewer jobs for those groups.
Yeah, I mean, that's a very good point to look at the unemployment rate by state for high schoolers and teens. If we can get that state data, that would be great to follow up on. Eric, why don't you field? We've got 3 questions so far. I'll be happy to think we can accommodate a few more. So if any of you would like
Yeah.
to join up, go ahead, Eric.
Cool. We'll start with Saud. Hi, Ed and Eric. Corporate profits seem to be fine and growing. Doesn't that correlate positively with hiring, along with the overall health of overall employment, sorry, and reduces the risks of a recession? It doesn't seem to make any sense with margins and profits improving.
Take it away, Eric.
Yeah, I think that's part of our story. Like if you look at one of our charts that we like to show is S&P 500 forward revenues and the correlation with non-farm payrolls. And they're tightly correlated. Like, companies with, growing profits and who are profitable tend to keep hiring. Of course, that, forward revenues have to line up with actual revenues, but they track pretty well.
Eric, you mean forward earnings? I mean, it's the same
forward
story.
Earnings, yeah.
So if you got forward revenues going up and you got margins improving, you got forward earnings going up. And our simple thesis is that profitable companies hire and unprofitable companies fire. So take it away, Eric. Who's next?
Yeah, we have James, Santa Monica local. Hi, James. Is it worth making the distinction between getting back to neutral, aka taking the foot off the brake, versus becoming stimulative and stepping on the gas? In other words, would or should the Fed think about those decisions differently given the current inflation situation?
Well, I think the Fed is basically declared mission accomplished. Fortunately, none of them actually used that phrase, which would have been a real jinx. But I think they all feel that they're patting themselves on the back, and they've kind of come to the same conclusion we've been coming to 6 to 12 months ago, well, maybe 6 months ago, is that if you take out rent inflation from the consumer price index or even the deflator, where we already arrived several months ago. We got down below 2% on a CPI basis. So, and we all know that rent inflation is a laggard, and so it's actually easy to predict just by watching current market rents. So we knew that we're heading in the right direction and we're going to get closer to 2%. And I think it was July CPI that kind of made them realize that they were there. And then the August CPI kind of confirmed that. And so ever since Jackson Hole, the Jackson Hole speech, there's just been a complete pivot by Powell and the Fed to the idea that, the risks had been that inflation might go up more than the unemployment rate might go up. And now they're saying some of them are saying it's balanced, but some of them are actually saying, including Powell, saying that the big risks are that the unemployment rate will go up. So they're very comfortable with the inflation forecast. And I think their language is that they want to be less restrictive. They're not really saying they want to be stimulative because we're not really in a recession, but I think they do want to be less restrictive. Again, Eric and I don't think the economy needs that much help. But if that's what they want to do, so be it. Hey, look, what's the worst case scenario? They lower interest rates too much and they get better than expected economic growth. And we think that'll come out of productivity, which will help to lower inflation. I mean, the worst case scenario, of course, is that we have another streak of really bad luck and inflation makes a comeback. Then the whole story changes pretty dramatically. Go ahead, Eric.
And I think we also don't really love the idea of, adjusting an overnight nominal rate for like the annual change in inflation. It doesn't really make sense. I also don't think it reflects financing conditions that well. Just last week, Uber raised long-term debt at 5.3%, which is quite literally the Fed funds rate. It was Treasuries plus 130, and it was the 30-year plus 130. But Uber just got upgraded into investment grade and they're raising at the overnight rate. So clearly, like, the real Fed funds rate is not, it doesn't just gradually become more restrictive. That's not how financing activity works. So I don't really love the idea of that. But clearly there's several Fed officials who do. And so they're going to cut as that number goes higher.
Makes sense. Go ahead, Eric.
One thing about our microphones not being that calibrated, I'm actually having mic issues, so I will get that sorted out. On to Michael Brush. Any reasons to think that this September and October stocks won't see the excessive weakness that often happens?
Well, look, if they do 50 basis points, as we just kind of sketched out earlier in our call here, then you could certainly flush out another round of carry trades. But again, if you're a carry trader, who doesn't know that trade's in trouble? And so I would think that the second flushing out would bring us closer to the end of this process. I was asked in Bloomberg this morning whether I agree with Mike Wilson over at Morgan Stanley that this could last a lot longer. And I said I thought that was a little bit too pessimistic for me, that it's not going to last for very much longer. But could we have another flush on September 18th if it's 50 or if it's 25 and Powell is ultra dovish? I guess we could. So yeah, September could still be a troublesome month. You got to be flexible in this business, right? I mean, we all know that when interest rates come down, the stock market should go up, unless, of course, you're in a recession. But if you're not in a recession and the Fed's lowering interest rates to avoid a recession, that should be bullish, unless there's a little carry trade problem somewhere along the line here. Also, by the way, there's uncertainty about politics up ahead here. So we're thinking after November 5th, after some chopping around here, we'll be back to making new highs in the market, and we're not down in technology. We think technology is still going to be a winner. Eric, I think that kind of fills our half an hour allotment here. Eric, thanks again as always for joining me. Max was here. You may have seen him. He left. Mark agrees. Max agrees with us. Max in the market thinks market's going to go sideways here for a little while. Have a great week, everybody. I'm going to be taking a vacation. My wife and I are going to go to Italy, to Portofino and Lake Como. So we'll be having a good time there. But I'll have my laptop with me. Eric will conduct the next weekly web chat. Thanks, Eric. All the best.
No problem. Thanks, everyone. Have a good one.